2013 to 2023, the UK has lost out on 20% of GDP from not being invested in stocks, in shares. Compare that to America, well, you can see the difference, right? Americans are wealthy, we generally are not.
The word risk is seen as a negative connotation in everything that this country does.
And I think Martin Lewis, money saving expert, is probably one of the worst people for the UK's investment culture.
Hello and welcome to The Market Edge. Now, if you're playing it safe with your money, you could be missing out on serious gains.
Today we're unpacking the hidden cost of British people's risk aversion. And we're also going to be looking at why the US banking boom might be the biggest and most surprising story of the whole year.
That's right, we'll look at some of the stocks to watch and some of the mindset traps you need to avoid. So, this is The Market Edge. If you're listening, watching, whatever you're doing, like, subscribe, and you'll be served up in the Market Edge podcast whenever it lands. Let's first of all touch on the elephant in the room. Outside, it's 16 trillion degrees.
Yeah.
So we're wearing shorts, and for that, I want to apologise.
I
mean, you wear shorts every week.
I'll make no apologies for that.
I apologise. Let's start with meme of the week. Now, this is legendary Jim Cramer. Legendary wrong all the time, Jim Cramer, obviously, right? Jim Cramer, there's a picture of the Titanic. There's his tiny little bobblehead down in the corner. It says April 11th, 1912, which is, of course, a few days before the Titanic sank. And it says, this ship is unsinkable. And that's because, of course, Jim Cramer is always wrong.
He is, but the other week he actually tweeted that the bull market basically isn't going to end. And so I started absolutely, defecating myself. Because I do quite like to think that Jim Cramer...
in such a lovely way, I feel.
Jim Cramer is quite a contrarian voice.
Yeah.
But you know what? Someone ran some analysis of his trades over the last 5 years. I think they did this maybe during COVID. And it actually came out that he wasn't always wrong. He was...
Yeah, but of course, there is a reason this guy has been on CNBC for 25 years. And it's not just because he's shouty, surely.
Yeah, he actually does provide some pretty decent insights.
Yeah, exactly. But... And of course, and for those people who don't know who Jim Cramer is, right? He's been made famous for shouting at CNBC mainly. He has his own little segment, or used to. But it was the Bear Stearns one, right? That was his most famous. Bear Stearns is fine. I'd go and buy more Bear Stearns now. Bear Stearns goes out of business.
Yep.
In a day.
Yeah, but look, everyone's been there.
Yeah, of course.
Do you know what I mean? Apart from me, but everyone else has been there.
Why do you think I'm still employed doing this podcast?
But I think the interesting thing with the way that people like to fix on sort of a meme is that they really, really do love to repeat something, even if it is completely not true. And
it's two things, right? People love to repeat something over and over again, and people love to rip the piss out of people.
Yeah, but you know who's worse is Marko Kolanovic, who was at, I think it was either Morgan Stanley or JP Morgan.
Yeah.
He kept talking, and he's a macro strategist.
Yeah.
Which... they're getting rid of loads of strategists at banks for very good reason. And he basically was completely wrong. And so now whenever he says something on Twitter, he is the new Cramer. Yeah. But the funny thing about him is that he intellectualizes things, whereas Cramer's just like, buy this stock.
Yeah.
Whereas this guy makes a whole macro case,
There's a thing, I think there's an interesting dynamic between this, because I was a chief market analyst, right, at Retail Brokers. Now, Retail Brokers, great, but... And I was chief market analyst and still am an analyst doing financial market content and giving my insight. But if I hot-footed it over to Goldman Sachs, put my CV on the table and said, I want to be a chief analyst, I'd probably get sniped.
Yeah.
Just to leave.
But that's okay.
It is okay.
There's a lot of stress at banks as well.
I don't want that job.
It's awful.
Don't want the money or the job. Who cares?
Too much work as well.
Yeah, exactly.
So meme of the week too is Trump effectively saying that Jerome Powell is a donut because he's not lowering rates fast enough. Now, I don't actually know if this is real or fake. I just kind of saw it on Twitter and it was really, really funny.
Yeah.
But the whole thing at the moment is that, Trump really desperately wants rates to be lower. He's looking at a new appointment and he's looking to get rid of Jerome Powell.
Now, I think personally, right, I think this is the biggest market story in the next 6 to 10 months. The replacement of Jerome Powell at the Fed, you know. So obviously Trump's been vying to get rid of Powell ever since he started. He started putting the boot in during the election campaign, right? About Powell's policies and whatever. Now, of course, he wants lower rates because lower rates push the stock market higher. And what all presidents want to do is go, look how high the stock market is, right? Now, he doesn't necessarily need that because the S&P is hitting all-time highs on a daily basis. Yep. So he doesn't need lower rates necessarily. Right. But lower rates help money in people's pockets, so he wants people to also have more money in their pockets. But the whole independence of the Fed is a massive talking point, has been for it. All central banks are independent, right? Supposedly. All central banks are independent. Jerome Powell is coming to the end of his term anyway. Now, on the FOMC committee, there are 2 Trump-appointed people. Don't ask me their names because I can't remember what they are. But there's 2. When Powell goes at the end of his term, and I don't expect it that he will be pushed out, shorter than that, he'll go at the end of his term, it is massively important to market stability who then replaces him.
Yeah, I think, Powell was a Trump hire.
Yeah, but now he hates him.
Yeah. But that's
so
just Trump.
Elon Musk was a Trump hire.
Well, exactly. One of our big predictions, or at least my big predictions, they would have
at least my prediction.
Fallout.
Don't do that. Don't do that. It was a podcast related prediction.
It was actually one of my TikToks.
Okay, good. All right, great. So glad that you've got proof.
We can clip that.
Yeah.
But they're having a falling
that.
out. No, don't clip that. But they have a falling out. It's just 2 massive egos. Yeah. But the interesting thing though is that I think 30-year mortgage, the average 30-year mortgage rate in the US is about 7%.
Yeah.
So I would argue that is one reason, and new home sales are absolutely decimated in the US, by the way. I think that's one reason why Trump actually wants interest rates lower, to get that 30-year rate a lot less.
Yeah.
He wants to reinvigorate that.
Kickstart the housing market.
Yeah, exactly.
Yeah.
And there's a trade there, which is, new homes being built, perhaps, might want to buy the likes of Caterpillar, which make diggers.
We spoke about Caterpillar last week, didn't we?
Which is exactly why I've mentioned it again. And so I think, there is a very, very, very valid reason, but at the same time, he's then got to think about, what about all the people who still can't afford homes? If you make rates cheaper, price of property is going to go up, there's going to be more discontent, et cetera, et cetera. So who is your core voting base? And recently it's become younger Gen Zers. Yeah. And, that difference between Gen Z and millennial, I don't really know what they're called actually. And so he's got to think of them too. And this recent voting base might be put off if property prices go up again. It's just a factor of economics. So something to think about for him.
When you talk market stability, again, remember, when we talk stability, we're not talking rational. Market stability doesn't depend on rational things. No. It depends on crazy basket cases all over the place, whether that be Elon Musk, Vladimir Putin, Israel, whatever it is, conflict. All of these things are never ever, the way anyone else would expect them to happen. They're just crazy situations. And this whole Trump Fed situation is, I think, massively important. So, tweet of the week. This is from Morgan Housel. And this is a chart over the years of the S&P 500. Now, we always talk about things going up and to the right. S&P 500 going up to the right. It says, a book called Shut Up and Wait. Each page is just this chart.
I might make that.
Yeah.
I might make an ebook.
Yeah.
And charge people like a tenner, and then just run some Instagram adverts on it, and then just hopefully that will, and this is leading into our next discussion point about Brits, but hopefully that will change some minds, because it's true. All the S&P 500 is a function of US growth, and if the bet that you're making by being long the S&P 500 is that you do not believe that the US is going to implode in the next 5 years. Yeah. That is consistently the bet that's being made.
Exactly that. Yeah.
Because as long as the US is growing, it means that it's defined by corporate earnings growing, which means companies are making money, which means that everything is absolutely fine. Now, it does matter who's maybe making that money. If it's defense companies, actually, I don't care. Defense companies.
It doesn't matter who's making that money.
It doesn't matter.
No, it doesn't matter.
That's the point. So, look, the thesis should always be, if you think the US is going to see
Not going to implode.
Yeah,
Yeah.
then just be long the S&P 500. It's
Yeah.
very, very simple. And then maybe trade around it with, some Teslas, some
Yeah, because
Nvidia.
you're going to have some ups and downs.
Have a little punt.
Yeah. Look, and the one downside here is the Great Depression, right? The one
downside, and the S&P 500 wasn't even constructed then, so these charts don't even make sense.
Yeah.
The S&P was constructed in 1958 in its current form.
And that is 1930 something.
1929.
My time.
Great Depression is 1929 to 31.
Yeah, there you go.
I literally went to university and did economics. That's the only thing I remember.
Certainly didn't help any trading or anything like that. No,
it's not helped with anything, to be honest with you.
No.
But yeah, stay long the S&P if you want to be wealthy.
Yeah, I mean, it goes up. We spoke about all this stuff at the start of the year. We said we expect the S&P to be higher. We expect US stocks to be higher, even though there's fear of recession. Yeah, so let's move on to our chart of the week. So chart of the week this week is, and goes into our title, is all about risk aversion. And this is, I'll let you describe it a little bit more. It's your chart. But risk aversion is leading to an over-allocation to cash.
Yeah, this is literally the UK's biggest problem.
Yeah.
And the biggest problem, by the way, is you, if you have any money in a cash ISA.
That was directly at you as well.
Yeah. This chart is from JP Morgan, and they did basically, I think the chart is a study of UK savers or something like that.
Yeah.
And this is effectively asking the question, you mentioned you believe cash savings are best when saving for retirement. Which of the following best describes why this is? And now by cash savings, what they mean is short-term money market deposits. So it means that they're invested in very, very low duration bonds, which have zero duration risk, which basically means that it's not going to get dislocated from the price, and very little credit risk because you're invested in, say, Bank of England, 1 year gilts, for instance, or
stable as you like,
UK gilts, and other term deposits like that that are very, very short term. The fact that people don't really understand that you can actually hold exactly the same money market fund or exactly the same product in a stocks and shares ISA, which is why people prefer to allocate to cash ISAs, is quite frankly insane. Now, it says that it's easy to access the money if needed. I can access something from a money market in 5 minutes. You just sell it and then you withdraw the cash.
But there's a whole big point here around pensions, right? So we're doing some research recently for something else on pensions, and pensions are actively looking to be less risky, right?
Yep.
There's no risk. Now, let's strip back what a pension is. A pension is an investment, right? You are investing in a portfolio of assets to earn more money when you retire. However, the most popular pension products in the world, and I think it was the Vanguard 40 I was looking at. Again, they're all looking to diversify more. Now, if you look, the more you research into these things, diversification is safe, yeah, but it just means you don't make any money.
Diversification, Warren Buffett famously said this, is for people who don't actually know what they're doing.
Yeah, diversification is for people that don't want to make money.
Yeah, and the problem with the UK is actually, so after 2008, a lot of the regulatory stuff, especially related to defined benefit contributions, meant that there was an automatic shift to bonds because obviously defined benefit is paid by a company out, and then if there's any extra funding, it just goes into bonds. Most people are in defined benefit contribution pensions, right? And the issue with that, I think, is that then discourages any further investment outside of that pension.
Yeah.
So the allocation in defined benefit is basically just a kind of one-for-one cash. There's no actual added investment. Whereas in the US, it's heavily 401k, for instance, where you manage it yourself or you put it into a fund and things like this.
Yeah.
So if you look at the second reason there, I'm afraid of losing money if I invest in stocks or other assets. From 2013 to 2023, the UK has lost out on 20% of GDP from not being invested in stocks, in shares. Compare that to America, well, you can see the difference, right?
Yeah.
Americans are wealthy, we generally are
But
not.
we have this massive. Not only is it a risk aversion problem, it is a financial literacy problem in this country.
It is.
Whereas in the US, you have. I think I read a stat that 40% of users of social media in the US are using Instagram for financial advice.
Yep.
Now, you could, in this country, we will look at that and go, ha ha ha, you're using Instagram for financial advice. What a ridiculous way to look at it.
I'm going to say something very, very controversial here. And I think Martin Lewis, money saving expert, is probably one of the worst people for the UK's investment culture. So many people look to him as a kind of savant, but all he's doing is coupon clipping. You know,
Yeah.
all that he is describing, like,
Which there is a place for, of course, because not, there's two sides to this, right? Because there is not everybody has money to invest.
no, there's not. But at the end of the day, it's a very, very tricky one. That policy starts from the top down,
Yeah.
and that is very much even a broader question than what we're talking about here. That starts from, okay, what is the structure of the UK,
Yeah.
and what is the aim and goal of the UK here? I mean, we import natural gas from other countries when we've got gas fields just to the north of Scotland.
Yeah.
which
Well, I mean,
could
look at the
easily be
agriculture and
used.
food industry.
Everything is a complete basket case. I think we've been through
Yeah,
this
yeah.
a couple of months
Yeah.
ago.
We're going to change this to the UK bashing section because it's every single week.
Well, it's relevant, you
Yeah.
know. But I think the one big thing with British investors is they look for safety. They don't look for returns.
Yeah. And this is, I was having this conversation the other day that there are people either go, there's two ways you look at investment. You're either investing or you're taking risk. I mean, that's mad. You can't, life is risk, right? I mean, without getting too deep into anything, but you know, risk is inherently seen, the word risk is seen as a negative connotation in everything that this country does.
Yeah.
Risk is negative. There is a risk. Don't do it.
Yeah.
Risk. No, not going to do it.
It's all about paternalistic and nanny statism, basically.
Yeah.
And I think what people need to do is shift themselves along the risk curve.
Yeah.
So when they're going, okay, I might put money into a cash ISA.
Yeah.
It's got to be, no, put it into the most liquid stock market in the whole world, where in fact you can withdraw your money within 1 minute by selling. And you're more likely to make a better return.
Yeah.
Which is, you know, the S&P 500, for instance.
Yeah, exactly.
And then once you've actually, say you've never invested before, I think the number one thing you can do is just go and buy one share of the last company that you use that's listed on your bank statement.
Yeah.
That's something that I'm telling everyone at the moment
Yeah.
to go and do.
Yeah.
Just because that's an entry point that you're familiar
Yeah.
with.
Don't have to go crazy.
A share of a company can be £9.
Yeah.
It does not matter. But from there, once you've realised, okay, this is relatively easy, there's no pain. Because
Yeah.
for most people, it's the anticipatory barrier that stops them from doing stuff. It's not the actual doing.
Yeah.
It's the nerves before they enter something new. And I think Brits are very, very, very like that.
Yeah.
Kind of stiff upper lip. They're willing to suffer through things, even though everything's a bit shit. And I think, you know, once you get past that barrier of, okay, I can actually just chuck a bit of money in here each month and then see it grow.
And do you know what? There's actually a football analogy in here because we for a long time football was very risk averse, right? Don't concede, don't concede, don't concede. And now you hear managers continuously saying things along the lines of, "We take risks by not taking risks." Mm-hmm. You know, and you think about that from a football perspective. You don't take a risk to take a player on, have a shot or whatever. You just don't score, right? Mm-hmm. Fundamentally exactly the same thing. You take risks with your future by not taking any risks.
All of it is just an opportunity cost issue.
Yeah.
And by holding money in, say, a cash ISA, which Brits have lost £500 billion out of between 2013 and 2023.
Yeah.
£500 billion is a lot of money.
It's a lot of
people,
money.
But the thing is that people can't conceptualize that amount of money. Up
Yeah.
to 1 million people tend to be able to.
Yeah.
Beyond that, no chance.
Doesn't make
And
any
this is why it doesn't really hit home with people.
Yeah.
And I think, you know, that is a hell of a lot of money to have lost out on. And we could literally be taking wealth from the US by investing in US companies and bringing it back to Britain.
Yeah.
They're buying our companies,
Yeah.
you know, at a massiff discount, by the way. There was a
We'll sit here
98%
and cry about it.
a 98% premium applied to a listed British company just recently. I think it was Statinis. We might have mentioned it, actually. A 98% premium, which is huge. Americans have so much money because they care about their capital markets. We
Yeah.
don't care about our capital
No.
markets here. You've got Julia Hoggett at the LSE, who, yeah, fantastic. You've done really well for LSE or London Stock Exchange Group shareholders, but you've done absolutely F all for the actual domestic market. You've actually made it worse. Whereas in the US, that would not, stand. They would not stand for that.
Yeah.
And so these people need to be held to account a little bit more.
And this is where protectionism becomes this horrible word that everybody hates.
Well, yeah.
But
I mean, the US think that they're the best country in the world. We don't seem to think that.
no.
And that's why we have really poor decisions. We care more about what others think than what we care
I
about.
came through
Anyway.
Heathrow Airport yesterday. I can tell you we're not the best country in the world.
No, it's a dumb. I thought the same. I came back from Cyprus and I was like, why is everything so dirty? Like,
Yeah.
have some pride, you know what I mean?
Horrendous. Let's look at our chart and trading idea for this week. Super microcomputer.
Yeah.
Now,
so,
chip maker, right?
chip maker.
Yeah.
They are the most heavily shorted stock in the S&P 500.
Now we
by
showed you
he-
the shit. We showed
by
you
hedge funds.
the chart of the S&P 500 before, right? So
Yeah. So what you've got here is you've got the AI narrative back again. You saw Micron, I think last week, beat earnings by a fairly decent amount. I think it's about 2 or 3 billion they beat their either revenue or income, can't remember now, which was massive. And I think when you start to see a narrative come back like this, and especially with the strength of the S&P 500 now, you can see beta coming into play, so you can see some outperformance.
yeah,
I think that if some firms start to close off their short positions here, this could run really, really hard.
yeah,
We're above the moving averages as well, which shows that a trend change is occurring on different time frames.
Yeah.
Mate, I love it. I think it's a great shout there. I'm not saying rush out and buy it. I'm saying just pay attention.
yeah. Just don't go and sell it. Anyway, on that bombshell, I think we should leave it.
Yeah.
Super microcomputer is the chart you should be looking at. Look at the S&P 500 over the last 200 years, and you'll find that even when they made up the prices, it was still going up. Thanks for watching. Like and subscribe. Get the market edge anytime you want it. See you next time.